Hi, everyone. Thank you for joining us today for Kroll's ALTLOOK quarterly market update for Q3 2024. I hope everyone had a wonderful summer as we begin a transition to the fall. Today, we are happy to have a special guest, Josh Tucker, who will give us some insights on key geopolitical risk across the globe. So given we have a packed agenda for you today, and a few new faces, in the interest of time, I'm going to be moving pretty quickly through these next few information slides. Okay, so as many of you may be aware, Kroll is the largest valuation provider in the world. We do have some additional services that we provide, including corporate finance, cyber risk, restructuring, fairness opinions, and ESG. So to get through a few housekeeping items here, as a reminder, this webinar is being broadcast live. We suggest that you enlarge your media player to full screen when you're viewing the presentation. We encourage you to submit questions throughout the presentation, and you can do so on this screen here. You can submit questions electronically through the webcast console Q&A widget pointed down here below. If we don't have a chance to address every question, as I suspect we won't be able to get through them all today, we will be sure to follow up with you directly after the presentation. Again, a recording of today's live webinar will be posted on our website and distributed over the next few days. So our quarterly webinars occur the first Thursday of the last month of each quarter. So our next call will be on Thursday, December 5th. And again, we'll try to limit the calls to 45 minutes each quarter. We're going to try and do that today too, but we may go over a couple minutes. Our quarterly, the typical agenda will be, covering new regulations. We've inserted geopolitical market risks, which we intend on talking about next quarter as well. And we've got macroeconomic update, and then we'll cover valuation hot topics and then any questions. Moving on to the speakers. So today, again, we've got Josh Tucker, our senior geopolitical risk advisor. Lea Carty, managing director of the private capital markets. David Larsen, managing director with Alternative Asset Advisory Group. Myself, I'm with the Portfolio Valuation Group. Rob Maxim is with the Financial Instruments and Technology Practice. Peter Salvatori, Managing Director of Portfolio Valuation, and Adam Schwartz with our Real Estate Advisory Group. So with that, I'll kick it over to David Larsen to talk us through the new regulations.
Thank you, Jenetta. It's good to be with you today. Nothing particular has come out in the regulatory environment that is new from a new regulation perspective. We're still waiting for the SEC to deliver on rules that have been proposed. Interestingly, one of the things that happened, I think, during the quarter is that the SEC's private funds rule was vacated by a federal court, meaning that it is no longer in effect. Now, that's not going to have, I don't think, too big of an impact. In that it was already best practice to obtain a fairness opinion for continuation funds. Most funds were fairly robust in their quarterly reporting. So those kinds of things, they had an audit. Those parts of the rule that are now vacated, again, I think that we will continue on with best practice there. A couple of the places that maybe are advantageous or disadvantageous, depending on your point of view, is that the rule did prohibit special treatment for some investors, meaning that you could not negotiate most favored nations status in certain circumstances. That's gone away. So now I think investors do have the ability to continue to negotiate themselves in certain circumstances. But that's the main piece. So I think to just highlight that. The other thing, and we can maybe touch more on this during the Q&A section, is that there has been a good deal of public market volatility. I think in particular at the end of excuse me, at the beginning of August. That's just going to raise questions if that volatility continues, if we have a big spike down or a big spike up, close to or over quarter end. How do we deal with that? And fair value, as we know, is based on what's known and knowable as of our measurement date. But that volatility will be something that needs to be taken into account as we move forward. I'd really like to now move forward and hear the insights that Josh has prepared for us. Josh, I'll turn it over to you to give us our geopolitical briefing, which is kind of we're at an interesting time, both in the United States, but globally, with a number of things that will impact the overall environment, and in particular, as they translate into valuing private investments.
Fantastic. Thank you so much, David. Thanks all of you for being here today, and thanks for having me here to talk to you. I'm going to try to do three things in my remarks to you today, all of which are tying into sort of geopolitical risk and how we can think about this in the context of businesses. The first I'm going to do is talk about trends in what's known as the 2024, the year of election. And then after I talk about what we've learned so far from the year of the election, I'll talk much more specifically about the US election and give an update on where things stand at this point in time. And then I'll use the last third of my time to talk briefly about global hotspots, some of which we can get back into during question and answer if there's more things that people want to follow up on. Right now we're in 2024, which is known as the year of the election. As famously at this point in time, most people have heard of this, populations in the world, countries in the world that have over half of the world's populations went to the polls this year, or were going to go to the polls this year in 2024. So we're about 2/3 of the way through the year of the election, and we can take a step back now and look at what we're seeing in terms of trends that have emerged through the elections, the many elections that have taken place in the first 2/3 of the year. I only have a few minutes, but I want to highlight what I think are three trends that are particularly important to be aware of. The first is we have clearly seen across continent after continent an anti-incumbency bias that's in the air here. We've seen this in places as varied as the UK, France, India, Iran, South Africa, Venezuela, even places in India where Modi came back to power. He came back to power in a sort of much more humbled position than he would have thought. Iran, not even a democratic country, but we saw an anti-incumbency sentiment with the more reformist, or at least looking more reformist at the time, candidate being elected. In South Africa, the ANC held on to power, but with diminished share of the parliament, and again, also in coalition government. And so it does lead to a kind of weird question for the US, which we'll get to in a minute as we look to the US election, which is, if we think there's an anti-incumbency bias that's permeating what's going on throughout the world, what does that actually mean in the United States? Now, if we were on this call a month and a half ago, we would have clearly said that was probably directed against Biden. But now we're in a very strange situation in the United States where we have an incumbent candidate, the candidate of the incumbent party, is Kamala Harris, who is the candidate of the Democratic Party. That's who we tend to think of as the incumbent and who we tend to think of an anti-incumbency bias pushing against. But in this particular election, we have the only candidate who has actually been president previously is running as the anti-incumbent candidate. So what this means for the U.S., I think, is still a bit up in the air and important to be thinking about going forward. But certainly, there's something about this that has left voters globally dissatisfied with current leadership, and whether that's effects from the economy, whether that's lingering effects from the pandemic, remains to be seen. But it's clear across multiple elections. The second point that we've shown is that in addition to just simply having an anti-incumbency trend across elections, we've seen a willingness for voters to vote for kind of newer parties, we may want to call in particular populist parties, smaller parties, sometimes more extremist parties. So it's not just the case that you're having center-right parties that are being thrown out of power and simply being replaced by center-left parties. We can sort of look to the UK where this happened, but if we look in the UK also, we see UKIP getting we see the Reform Party getting a larger portion of the vote than previously. And this is something, that we've seen in a number of cases. And quite frankly, we wrote these slides before this weekend's regional elections in Germany, where we saw in Thuringen and Saxony, again, far-right parties performing exceedingly well in this particular election, and including, and as well, a far-left party performing pretty well. And again, populist parties succeeding. So this is a second trend that we're seeing across these elections. A third trend I think that's important for businesses to pay attention to is the importance of electoral rules. Once again, this is raising its head. It's not, if you want to understand what's going to happen in an election, it's not simply enough to look at the popularity of different parties and see how they're doing. So the quintessential example that we've been given here in this election cycle is in the French elections. So if we looked at the European parliamentary elections in France, we had a situation where Rally Nationale, this is the party of Marie Le Pen, did exceedingly well in the French European parliamentary elections, winning the most seats, winning 30% of the vote, the most seats of any of the parties to the European Parliament from France. And this was such a sort of seismic event in the French elections that President Macron reacted by calling new elections. Now, as in the lead up to those new elections for Parliament, we saw lots of headlines about Le Pen's party triumphing again in the case of this. This election was only taking place a few weeks later. But what ended up happening is that Macron's party and actually Le Pen's party did not win the election. And why they didn't win the election is because the French parliamentary elections uses a totally different type of electoral rule. And it uses what's called a two-round majoritarian system, whereby you actually have to win a majority of the votes in a district or close to a majority of the votes in the district to get elected. And this allows for all sorts of new strategic electoral maneuvering. And what we saw in this particular case was the center and the left coordinating in the second round of this election to deny Rally Nationale a victory in this election. And instead, we end up with this, totally different situation than what would have been expected here, where, just earlier today, we heard that Michel Barnier of the Republican Party in France, a right-wing party, has actually become the new prime minister after a delay since the election took place this summer. So those, I think, are the three big takeaways that businesses want to think about. There's an anti-incumbency sentiment. The parties that are currently in power right now may not be the only parties. There is a willingness to consider new parties. But also, if you want to understand what's happening in elections, you really want to have a keen insight into the actual electoral rules, because different electoral rules can and have in this election cycle led to different outcomes, despite even similar levels of support for parties. All right, now let's turn our eyes. This is a perfect segue into the United States election, because if you're watching the US from a distance and you see the polling numbers that have emerged since Harris replaced Biden as the Democrats' candidate, you might think that she looks like she's cruising to a comfortable victory. She's up now by 3-4 percentage points in a lot of the polls. But of course, the US has a complicated electoral system. So we're going to get into that. All right, turning to the US. The first point we want to make is that the US election has been completely reset by President Biden's decision to no longer run for re-election. Prior to that decision, we were looking at a situation where Donald Trump, by all forecasts, by all polls, looked like he was going to be leading to a sort of comfortable victory in the election. That has now changed. Now, the key thing to note, as I mentioned a second ago, is that although Harris is ahead by a few percentage points in a lot of the polls, our best guesses right now about this election is that it's a coin toss, a complete coin toss. And there's a couple of different reasons why that's the case. One is that we're still not sure if the polling has kind of settled down from the post-convention bounce of after the Democratic National Convention, but also because in the United States, the key, you have to look to electoral rules. In the United States, as a lot of people know, and most people know in the United States, we don't have a popular vote of the president. We have the Electoral College. And so in the translation between how the different candidates are doing at this point in time across different states, and the states are the ones that actually provide the votes for the Electoral College, right now our best guess is that this election is a toss-up at this point in time. Now, that may change in the coming months if Harris continues to maintain the numbers that we're seeing right now as we get farther away from the Democratic National Convention. Our assessments in that regard may change a little bit, but at this point, it's currently a toss-up. And that, by the way, is a humongous improvement for the Democrats compared to where it was earlier this summer, where most forecasts had the Democrats having at best a 1 in 6 chance of President Biden being reelected. We are also beginning to see, as we get into the campaign more, important policy divergences emerging between the candidates. And there's been a lot of talk about each of these candidates being vaguer about what their policy proposals, but we're beginning to see more and more of these things. So businesses can start preparing for what it is the policies these different candidates want to emphasize. We don't have nearly enough time to go into these in this short webinar today. But for example, yesterday's announcement in her speech by Kamala Harris around her policies on capital gains taxes, while different from what President Biden had proposed with a lower level. There's clearly a distinction between what ex-President Trump is proposing for capital gains tax. And we're expecting to see more policy news from Trump today now at his speech at the Economic Club at New York. Trump has also, of course, been very vocal on raising tariffs and expelling immigrants. Both of these things would have effects on important economic effects on businesses and on immigrants. We would see this on labor markets. When we look to foreign policy, these candidates are going to have different implications as well, with very different, probably very different positions on Russia, Ukraine as one example. But the one thing that I want to really emphasize is that beyond just familiarizing yourself with the particular policy proposals of the candidates that are likely to be of importance to valuing your firms, when we think about the results of this election, as being forward-looking, we want to think not just simply about that there are two results of this election, either Trump getting elected or Harris getting elected, but actually, given the nature of policymaking in the United States, we should really be thinking about a world where there are four possible outcomes. There's an outcome where Trump wins the election, and he has control of the U.S. Parliament, which consists of two houses, the House of Representatives and the Senate. There's an outcome where he wins the election but doesn't have control of the legislature. Same thing for Harris. She could win the election with full control. She could win the election without full control. And in some ways, it's a fairly unusual election that all three of these, the House, the Senate, and the presidency, really could go either way. We could imagine either outcome anywhere in this continuum between them. But as you think about planning for policy in a post-US election period, you want to think about what these four different scenarios look like. And there are some interesting connotations that pop out of this, for example. For example, if you have full control by either party, you're probably likely to see higher deficit spending in the United States than if you have mixed control, with one party controlling the presidency and at least, the other party controlling at least one of the houses of Congress. Or if you think about within each party having full control of the presidency in both houses of Congress versus mixed control, having to deal with opposition control of at least one house, this has a big impact on, for example, as we just mentioned about the corporate tax rate, on whether or not either of the candidates will be able to implement their preferred changes to the corporate tax rate. And then the final thing I think that we need to be looking at in terms of the United States is to think about the possibility of political instability in the post-election period. Now, again, 8 years ago, this would have seemed, not something we tended to worry about in an established democracy like the United States. But of course, we saw in 2000 what happened. We saw in 2020 what happened. And there is not, there is a non-insignificant chance that we could see similar levels of instability. It may be that the results of the election are not known for a short period or a longer period after the election. It may be that one candidate refuses to accept the results of the election, as we saw this happen before with Trump in 2020. So you may want to be thinking about, in terms of planning, like what's going to happen if there's actual political instability in the United States after this election. Okay, in my remaining few minutes, I want to just touch on very quickly current global hotspots that you may want to be thinking about as you move forward. As you move forward. The big ones, of course, remain the same in terms of the Middle East and Ukraine and Russia. In the Middle East, we've seen developments where we are sort of teetering between the possibility, once again, of maybe a de-escalation with the possibility of a ceasefire. We know the Biden administration is trying hard to get a ceasefire through. We've seen renewed pressure from Israeli society on Netanyahu to try to go to a ceasefire. In the same respect, we could go in the other direction, where we could accelerate. There could be an acceleration of the conflict. We're still waiting on responses from Iran to the assassination of one of the Hamas leaders on its territory. There's still continuing conflict going on between Hezbollah and Israel. So we're in this really tense situation where we could see a de-escalation, or we could see an escalation, or what we've continued to see is a continuation of the status quo. In Ukraine and Russia, we saw this interesting thing happen in the last couple of months, where the Ukrainians surprisingly ended up attacking and holding territory in Russia. It's the first time anyone's held territory in Russia since World War II. Why the Ukrainians did this is something people have still speculated on. There was obviously a morale component to this. There was also a desire to bring the war to the aggressors. But at the same time, there was also speculation that this was designed to sort of refocus Russia's attention away from the southeastern part of the country. That does not seem to have happened. There's a third speculation here that part of the reason to hold territory is that the Ukrainians may want to have better bargaining position if there is negotiations to come. So more to be seen on this, but it continues to be an issue, and the possibility that this could lead to bargaining in the future is something that's worth watching. We've also seen at least one of the elections that took place recently in Venezuela remain unsettled. Going forward after the election, this election remains heavily disputed and still is in a kind of conflict situation at this point in time. The results of the election, with Maduro claiming re-election, has only been recognized by a handful of countries around the world. And you've had countries like the United States and other Latin American countries that have in fact recognized the opposition as having won the election. This can have business implications in terms of oil prices. There may be additional sanctions on Venezuela. It may impact inter-American relations. And if the opposition candidate Gonzalez does eventually get seated, this would end up leading to very drastic changes in Venezuelan policy, both domestic and foreign. I'm running very short on time, so I'll just briefly say in Bangladesh, we got a reminder again that you can get changes of government that are consequential even without elections, as we saw the removal of Sheikh Hasina from power. This has all sorts of implications as well for the Southeast Asian continent. We can talk more about in Q&A if people are interested. And then finally, I put MPOX on this slide just to remind people that, again, this question of global disease and global pandemic remains something that needs to be on people's radar screen. If you're doing business, especially in Africa at this point in time, this is something, but we're still seeing cases spread, so it's worth keeping an eye on as well. All right. I'm out of time, so I'm going to pass it along to Peter.
Thanks, Josh. So I'll be real brief here, just to touch on some of the key highlights, mostly here in the U.S. Economy. So to begin here, we've finally seen a shift. I think this might be our 5th ALTLOOK webinar here, and I think the last 4 have been 90% occupied by the word inflation. So we're kind of now here starting to finally see the turn of the tide. And with respect to economy, inflation's kind of going into the background, but we're starting to see now more of a focus on the labor market. And the shift can also be witnessed in both short and long-term treasury rates, both notably lower here since the end of last quarter. So just a couple key data points on the inflation front here in July. The CPI index increased 0.2% for the month, putting the 12-month inflation rate at 2.9%. It's the lowest read since March of 2021. On the unemployment rate for July edged higher to 4.3%, its highest since October of 2021, however, still well below historical norms. On the jobless claims front, for the week ended August 31st, and I will note this report just came out this morning, so it won't tie to what we're here presently showing in the deck. The seasonally adjusted claims was 227,000, a decline of 5,000 from the previous week's level. And again, the lowest read here since early July. Just yesterday, the latest job openings and labor turnover survey, or commonly referred to as the JOLTS report, showed that available positions fell to 7.7 million in July, off about 237,000 from June's number, and the lowest here in 3.5 years. So with this decline, it brought the ratio of job openings per available worker down to less than 1.1. And that's about half of where it was at its peak of more than 2 to 1 here in early 2022. And lastly here, just this morning, the ADP private payrolls report showed companies hired just 99,000 workers for the month, less than the downwardly revised 111,000 in July, and below the consensus forecast of about 140,000. So all this jobs data is essentially saying that while there's been a clear slowdown here in hiring, which I think we can all agree was at an unsustainable level here and an elevated level, employers thus far have been reluctant to part with their employees. So this data has also paved the way here for the rate cut cycle here to finally begin. So as we sit here today, it's not an if, but how much. I think as of this morning, it's about a 50-50 breakout between a 25 and 50 basis point cut at the Fed September meeting here in a couple weeks. So with respect to outlook, I think there's just a couple themes to keep an eye on. One here is, as things starting to certainly soften up on the labor front, the question now is starting to be asked, did the Fed wait too long? So that chorus is growing a little louder. especially here with the softest jobs data that's been coming out here the last couple weeks. And then second here is inflation. So while it's still in the background, or while it's moved to the background, and there's been universal agreement, we would get down to that 3-ish% rate or high twos. What worries some here is that last mile going from 3% down to 2%. And if that becomes stubborn, I think the Fed's job becomes a little more interesting in a sense that the jobs data is going to be obviously telling them to cut, but there may be a governor on that if, again, the inflation outlook remains to be a little bit more on the stubborn side. So that's all I've got on the economy. I'll pass the baton here now to Lee.
Thank you, Peter. I'll narrow the focus just a little bit here for a few minutes and talk through some results from our database of performing private credit valuations in order to summarize what we're seeing in that market. The results I'm sharing with you today are preliminary in the sense that we have a large enough data set to deliver meaningful results, but we're still building it up, particularly historically. We have a beta version of our benchmarking capabilities up on our valuation platform, which I encourage you to use. If you don't already have access, please reach out to me and I'll arrange it. With that said, let's take a look at the data. So implied spreads have only continued to tighten since the Federal Reserve put its campaign to raise rates on hold in the middle of last year. To anchor our observations for the following slides, we're only going to take a look at first lien loans to US-based companies. The implied spread is the spread our analysts use to build the discount rate used in fair value calculations. Since the third quarter of 2023, implied spreads have tightened by 113 basis points to finish July of 2024 at 640. This tightening brings this benchmark to its lowest level in the last 8 years. At the same time, short-term benchmark rates have remained mostly unchanged. Implied spread tightening has supported a continued decline in implied yields. And since Q3 of 2023, implied yields have come in 150 basis points to 11.12% at the end of July. With falling yields, valuations have risen. And again, since Q3 of 2023, the fair value percent of par has increased another 19 basis points to finish July at 98.523. Spreads are driving these trends. I wanted to take a closer look at them. And to do that, we'll shift gears and consider spreads in the primary market. The chart at the bottom right summarizes origination spreads over the last 1.5 years. Each blue dot represents the effective spread of one of 1,185 originations. The orange line is the trailing 90 origination average of these effective spreads, and it reveals a greater than 200 basis points decline, comparable to the decline in spreads we see for first lien loans, for example, which is down 182 basis points. That's the blue line on that chart. But the variation in the kind of loans that come into the primary market at any point in time is substantial. It raises a challenge to understanding exactly what this decline is. For example, is the spread trending lower because there are more first liens relative to second liens in the past? In past ALTLOOKs, we've talked about how some loan characteristics impact valuations, and we can explore how these characteristics or factors impact spreads in the primary market as well. To do that, we analyze spreads with a regression model that seeks to explain primary market spreads on the basis of factors we've looked at before. Factors like size, term, credit risk, and the overall market. For credit, we incorporate obligor risk, that is default likelihood through leverage, and we incorporate instrument level risk through consideration of priority of claim. We then correlate these origination spreads, which is shown at the chart in the upper right. Here, we outline the spreads we've seen in the market for each level of leverage for obligors or first lien loans. And this allows us to summarize the portion of loan spread that's attributable to a loan's priority of claim and obligor leverage. The coefficients of this model can be interpreted as prices of the factors that we're using to explain spreads. That is, if a term loan is 5 years, the price of that term loan will be in units of basis points of spread per year. So that the product of the two is the contribution of term to the loan spread. The chart on the lower right hand tracks these prices for the size and for the term factors, with size represented by the orange line, and so term by the blue line. They're both negative, indicating that larger sizes and longer terms work to lower primary market spreads. can also see over this period that they've become even more negative, creating an even more moderating impact on spreads. The chart at the upper right of this next slide is similar to the previous chart, but with different factor prices. Credit in orange on the right-hand axis, and the market, the overall market, in blue. Credit is positive, meaning that the greater credit risk generates a higher spread in the primary market. But these two factor prices are moving in opposite directions. The price of credit increased 26% over this period, meaning that the market demanded 26% more spread for the same level of credit risk at the end of this period as opposed to at the beginning. But at the same time, the market price of risk, that is the blue line, declined by 33%, acting to reduce spreads. The evolution of factor prices is only part of the story. To get back to the decline in the 90 observation average primary market spread we saw earlier, we need to convert factor prices to spreads by multiplying them against the factors. Intuitive candidates for these factor values are those of the primary market at both the start and the end of the period. E.g., in December of 2022, the average loan term was about 5 years. The average size was about 240 million. The average credit was a first lien of a company with 5.5 turns of leverage. If we let factor prices and factors change over the entire period, we can get a view into the drivers of this 200 basis points decline. And the chart at the bottom right provides this decomposition. The units are basis points of spread, and so the columns add up to the total change in spread. Taking into account the factor levels, we can see that the contributions in size and term, the first two columns there, to the market's overall decline have been very small. The interesting result, or one of the interesting results of this analysis, is that even though the price of credit has increased substantially, granting investors more spread for the same unit of risk, that benefit has been swamped by the effects of the market factor, which has worked to lower spreads significantly. A final point I'd like to make before handing this over to Adam is that if you turn your attention back to the top chart and look at the blue line, that is the market line, you can see that the market price of risk bottomed out at the end of Q1 and has moved upward ever since. This is interesting because it's the dominant contributor to the market spread declines, and it stopped moving downward at the end of Q1 and has started moving upward for Q2. That's what I have prepared for you today. Please don't hesitate to reach out to me at this address if you have any questions, comments, or suggestions. With that, I'll hand the mic over to Adam. Thanks.
Thank you. I'll talk about the commercial real estate market and where we are today. We have seen close to a 10% increase from the same time a year ago. One of the key factors in what property types we've seen increases in, with the AI push towards data centers, we've seen an increase in cold storage and also a drive towards a single family residential market. And the biggest area of increases we've seen is more on the West Coast, markets such as Seattle, Los Angeles, San Jose, and the Oakland markets. Another trend we're seeing is sort of towards the REIT privatization over the last couple of months. And this is highlighted from transactions such as Blackstone's purchase of Air Communities and Tricon Residential. Another large transaction I wanted to point out is KKR's 18 property acquisition from Forterra for $2.1 billion. One of the key topics we've been seeing from clients over the last year is liquidity. There's been a rise in interest rates, not a lot of transactions occurring. So with that, we've been seeing a large increase in continuation funds that are arising. And something about a continuations funds is it allows sponsors to continue to own an asset and continue maximizing its value without having to sell it potentially to a competitor. And it provides that liquidity to current investors. These investors come up with a choice. They can either cash out their investment as is, or retain exposure to the asset by reinvesting in this continuation fund. When the continuation fund makes these purchases, the price is typically determined by third parties, that is the buyers who are continuing to invest in this continuation fund, and it's typically done through an auction process with multiple bids received to ensure that there was a fair determination of this purchase. With that, a fairness opinion from an investment advisor is typically provided by the sponsor to the current existing investor base to make sure it's a fair and reasonable transaction. And this has become a legal requirement for investment advisors registered with the SEC. With that being said, Kroll, as a market leader in the space over the last year, we've rendered 15 real estate related fairness opinions. And this is highlighted by two that I'd like to point out with Lineage, which was the largest REIT IPO in US history, and more recently, Howard Hughes' spinoff to the Seaport Entertainment Group. Now I'll pass this over to Rob, who will talk about the commercial real estate loan market.
Thank you, Adam. So similar to the data set that Lee was looking at earlier, we've gone through and looked at a host of different commercial real estate loans, new originations in particular, and gathered some spread data for those loans. That's shown in the chart on the lower right here. We've also gathered some data on loan performance. That's in the chart in the upper left. Interestingly, and I don't think it's news to anyone, we've seen a fairly dramatic increase in the loan delinquencies as well as loans in REO or foreclosure for office. That's the green line that is angled sharply upward as you go through time here over the last couple of years. For other property types, we've seen a range of different delinquency rates. One thing that's interesting here is we constructed this data by looking at commercial real estate loans underlying securitizations that are in Intex. So taking that population, there's a large amount of agency securitizations, and many of those are in the multifamily space. Those tend to have very strong underwriting. And as a result, looking at the average delinquency rate for multifamily here, there doesn't appear to be a large increase. If we look and separate out the agency from the non-agency, there's actually been a fairly large increase in delinquencies in the kind of May, June, July timeframe for non-agency multifamily loans. And I say a large increase, that's starting from a fairly low point. So they're going from, for a non-agency perspective, going from roughly a 1% delinquency rate up to about a 1.5 or slightly higher delinquency rate, which is a fairly large increase, but not a fairly large level for the delinquency rate there. But still a noticeable trend for an increase there, and that's certainly something we'll be watching, something to keep an eye on. Turning to the loan side, as we move forward and we've moved from 2023 through to 2024, the loan spreads on hospitality have come down pretty significantly as different types of concerns, many of which were stemming or at least really kind of reared their head during the COVID period. As those have abated and many of the loans have been, many of the troubles with the loans have been worked out, solutions have been found, those spreads continue to decline. In terms of other property types, spreads remain relatively stable. Here we're looking primarily at first lien with first lien 10-year loans with LTVs between 60 and 65%. We, of course, have quite a bit of information for a broad spectrum of different types of commercial real estate loans. It can get very nuanced, particularly as we get into distressed loans, loans that are in workout, loans that are being restructured. As Adam mentioned, we do quite a bit of work on the restructuring side. Please give us a call if we can assist with anything, either from a valuation perspective or from a restructuring or arbitration perspective. With that, Jenetta, I'll turn it over to you.
All right, thank you. So a lot of great information. I think with that, we'll probably head on over to hot topics. And David, I'll kick it off to you.
So I want to, as we hit this, I think we've touched on some of these in our past webcasts. I want to hit a couple of questions that have come in. Josh, one question relates to your 4 possibilities in the U.S. election. If you were betting today, what's the likelihood of a split outcome, meaning the president in one party and one or the other of the House of Congress in the other party? It feels like that's a way that, let's say there'd be less extreme change one way or the other. Is that a possibility, or are we headed in a scenario where it's all one party?
I mean, given that there's uncertainty over all three, I mean, there's three outcomes here in the U.S. because you've got the House or the Senate, and my simplified four potential outcomes is either you have full control, so the party who wins the presidency wins both the House and the Senate, or you don't. Just by the numbers, if we really believe they're all kind of a toss-up, then yes, we think that there's a more likely outcome that you're going to have, or more likely outcome that you're going to have split control than that you would have full control by either party. It's not, but to be very clear, it's not impossible that you could have full control by either party. And what makes the situation so unique is it actually could be full control by either party. It's not if one party wins, it has a shot at full control and the other one doesn't. It's going to be hard for the Democrats to hold the Senate. I think there's a decent chance you could see a flip where the Democrats end up controlling the House and not the Senate. Interestingly enough, a lot of the House elections are going to come down to states that aren't swing states in the Electoral College. So you have a kind of mismatch in the sense that you have all the presidential money going after these 7 or 8 big swing states, but control of the House of Representatives may actually come down to what happens in New York and California. So you're going to see, the fact that Kamala Harris has had such an advantage in raising money since she took over will allow the Democrats to do things like target House seats in states that are not as germane for the presidential election. So I think there's a decent chance that we actually end up with this split. And I think the one that's, potentially most likely is this idea where the Senate flips to the Republicans and the House flips to the Democrats, ironically, because usually there's a lot of inertia here. So you could see a situation where Harris wins the presidency, has the House, but not the Senate. You could see the opposite for Trump. But I want to be very clear. These are all kind of razor's edge right now. I mean, this is just, you've pushed me on, if you were betting, what would you say here? And it is not, you should not be overlooking the possibility of either party winning with full control, or slightly less likely is that just because we tend to see coattail effects. And I think you'll get a little bit of gauge into this if you continue to see Harris being pretty far ahead in the polling for the national polling, even if the Electoral College remains to look quick. So if her post-convention bump doesn't fall off, then I think it becomes less likely that the Republicans will win the presidency and both houses of Congress. But if she comes back down and it remains close there, a lot of things can happen here. And so, but if I had to guess, I would say a split outcome is more likely than either party having full control.
And then we're about at time, but one of the countries that seemed to be missing from your global outlook was China. Is there and not to be provocative, overly provocative, but with the U.S. election, with maybe that possible political instability, does that give China an opportunity, given what's happening in the Middle East, Russia, Ukraine, to say now's the time for Taiwan?
I mean, I think that remains a long tail event. There's a lot of things going on domestically in China that China needs to be concerned about as well. But yes, in the sense that, as you said, if you are China and you're engaged in a strategic global competition with the United States, and if a change in the status is a long-term goal for the Chinese, this is something where, look, any analysis of geopolitical risk is going to be talking about, the possibility for what happens in the South China Sea and what happens in Chinese-Taiwanese relationships, Chinese relations. I think when we think about geopolitics and we think about the role the United States plays in stabilizing the political system, and we think about the increasing levels of geopolitical risk we're seeing throughout the international system generally, as we have seen the rise of China and as we have seen the rise of at least one political party in the United States that has much more of a kind of isolationist approach to foreign policy, as opposed to the U.S. continuing to play the traditional role it's done here. One question that we have to always ask is what happens if the United United States gets distracted. And the US is stretched right now in terms of its geopolitical commitments. And as we look to the election, when I said earlier in the talk here to think seriously about what happens if you have serious political instability in the United States and the United States becomes very inwardly looking for a focused period of time, this, of course, would be at the top of people's lists of things that would be the most disruptive, I think, of the sort of, long tail events that we're thinking about at this point to the global economy if you saw this. And it would especially, of course, be disruptive to people who are doing business with Taiwan, doing business with exports from Taiwan, doing business with shipping lanes that would be, that involve shipping lanes that would be affected by this. But I think it remains a long tail event in the sense that it's unlikely. There's not a great sense of this. But I think if the United States enters a period of prolonged political instability following the election, then you want to begin to think carefully about what some of the U.S. adversaries might do in an effort to take advantage of that situation.
So with all that, and it looks like, Jenetta, we're at time. If anybody's got additional questions, they can reach out. But as we enter the end of Q3, all of this flows into what would a market participant pay for an investment, whether it's a private credit investment, whether it's a real estate investment, whether it's an private equity investment. What would they pay? And we need to take all of these factors into account in assessing that in coming to a robust conclusion as we end out the quarter. So thank you.
Great. Thank you, everybody, for joining us today. Again, if you have any additional questions, please feel free to reach out to any one of us. We can help you with that. And as a reminder, our next webinar is going to be on Thursday, December 5th. So hope everyone has a great day. Thank you very much for joining.